Here's something almost nobody tells you about turning 60. Yes, your super lump sums can often come out tax-free, but if your money is still sitting in what's called accumulation phase, your fund can keep taxing the earnings at 15%. That tax keeps quietly eating your balance until you actually move it to retirement phase, and most people never even notice it happening. The number to burn into your memory is 15%. According to the ATO and Industry Super, that's the tax rate applied to your super's investment earnings while the money stays in accumulation phase, and it keeps applying even after you turn 60. Once that same money supports a retirement income stream, those earnings are generally taxed at zero, which is the whole point of getting this right. Let's make this concrete with real numbers. Industry Super and the ATO show that someone with $500,000 still in accumulation, earning 6% a year, makes about $30,000 in gross earnings. At 15% tax, that's roughly $4,500 lost every single year before compounding even starts. In retirement phase, those same earnings would generally be tax-free. Your first practical move is to check your access status using ATO online services through MyGov. Sign in, navigate to your super and retirement details, and confirm your age, your access condition, and your fund type. This tells you exactly which part of your balance can move from 15% taxed earnings to 0% retirement phase earnings, which is the single most valuable thing you can learn here. Second, review your benefit type using the ATO's guidance on tax on super benefits. The ATO says that if you're 60 or older, your payments may be tax-free depending on whether they come from a taxed or untaxed source and whether you take a lump sum or an income stream. Identify which applies to you before you draw a single dollar, because the wrong assumption can cost you for years. Third, where you qualify, move your eligible balance into a retirement income stream so those earnings stop being taxed. The ATO notes that retirement phase benefits from a tax source are generally not assessable income once you're 60 plus, and earnings in this phase are tax-free up to your transfer balance cap. This is the step that actually turns the 15% into zero. Finally, compare your fund using the government's Your Super comparison tool before you leave a big balance parked anywhere. Check your funds, fees and net returns against benchmark options. There's no point winning back tax savings after 60 if high fees quietly erode the same money, so make sure the structure you choose is competitive as well as tax smart. Take Mark, a 62-year-old electrician with $620,000 in super. Industry Super and the ATO show that if he keeps it in accumulation, earning 6%, his annual earnings are about $37,200, and roughly $5,580 of that is taxed at 15%. That's money he could keep simply by moving to retirement phase when eligible. Now stretch that out. Over a 5-year pre-retirement window, that drag is about $27,900 in avoidable tax, according to Industry Super and the ATO, assuming the balance and returns stay constant. And that's before compounding, which only makes the gap wider. This is why understanding your structure early genuinely matters for your final retirement income. The most common mistake is believing that once you turn 60, all your super and its earnings are automatically tax-free. The ATO says tax treatment actually depends on your age, the payment type, and whether the super comes from a taxed or untaxed source. Accumulation earnings can still be taxed at 15% even when you're over 60, so age alone does not unlock the tax break. The second common mistake is qualifying to move money into a pension but simply never doing it. The ATO and Industry Super show that leaving a balance in an account-eligible structure without converting keeps that yearly tax drag running year after year. Remember, the transfer balance cap, introduced in 2017, limits how much can sit in retirement phase, so check the current amount before you act. Let's run it back fast. Understand that accumulation earnings are taxed at 15%. Check your access status in MyGov. Confirm whether your benefit is taxed or untaxed using the ATO. Move eligible money into a retirement income stream where you qualify. And compare your fund with the Your Super tool so fees don't undo the saving you just made. If this cleared things up, do Future You a favour and subscribe, because we break down super and retirement rules in plain English every week. Next up, we're walking through exactly how the transfer balance cap works and how much you can actually hold tax-free in retirement phase. Hit subscribe so you don't miss it, and go check your own access status today.